Most people believe silver prices move because of speculation or short-term trading. That explanation worked in the past, but it no longer explains what is happening now. Silver is not just rising, it is behaving differently. And when a market changes its behavior, it usually means something underneath the surface is breaking. For decades, silver pricing has been dominated by the paper market. Futures contracts, leveraged positions, and algorithmic trading decide the price most people see on their screens. This system depends on one critical assumption: that almost nobody will ever demand physical delivery. As long as contracts can be rolled forward or settled in cash, the system stays calm. But today, that assumption is being tested. Silver is not only an investment metal, it is an industrial necessity. Modern economies rely on silver for electronics, energy systems, medical technology, and defense infrastructure. Unlike gold, silver is consumed. Much of it is never recovered. That means supply is far more fragile than most investors realize. When physical demand rises, paper supply cannot replace real metal. You cannot power an energy grid or manufacture electronics with futures contracts. You need silver that can be delivered. That is where stress begins. Right now, physical silver is becoming harder to source at scale. This is not a retail issue. This is happening at the institutional and industrial level. Delivery timelines are extending, premiums are rising, and regional price differences are appearing. These are not signs of a healthy market. They are early warning signals. When paper and physical markets begin to diverge, the system reacts defensively. Rules change, volatility increases, explanations multiply. This is not because everything is fine. It is because control is being tested. Silver is not sending a speculative signal. It is sending a structural one. To understand why this matters, you have to understand how fragile paper markets really are. Paper silver is not silver. It is a promise. A claim that assumes delivery will never be required at scale. As long as trust exists, that promise holds value. But trust is not unlimited. Once participants begin to question whether delivery can always be honored, behavior changes. Buyers stop rolling contracts. Large players seek physical supply. Leverage becomes dangerous instead of useful. This is when markets shift from trading to stress. At the same time, mining supply is failing to respond. New silver discoveries are rare. Production costs are rising. Environmental regulations are tightening. Recycling cannot close the gap because much of the silver used in industry is permanently lost. This creates a ceiling, a physical ceiling. When demand presses against that ceiling, price becomes the only release valve. Not because of excitement, but because of necessity. What makes silver especially volatile is its size. The silver market is small compared to gold or global bond markets. That means when pressure builds, adjustments happen quickly. Moves become sharp, pullbacks become violent. Headlines swing from calm to panic. This is not manipulation, it is imbalance. Many people will misread this environment. They will chase price moves without understanding why they are happening. Others will dismiss the signals because they look too extreme. Both reactions are dangerous. The correct focus is not price targets. It is system behavior. When systems lose balance, they do not correct gently, they correct suddenly. Silver has entered that phase. Another layer of this story is the broader financial environment. Global debt levels continue to rise. Governments depend on low rates to function. Currencies lose purchasing power over time. In this environment, confidence becomes fragile. When confidence weakens, physical assets regain importance. Not because they are exciting, but because they do not depend on promises. Silver sits at the intersection of trust and necessity. It is both money and material. That makes it uniquely sensitive to systemic stress. This is why we are seeing price discrepancies between regions. In a perfectly functioning global market, silver should trade at nearly the same price everywhere. When it does not, it means supply is being pulled toward where it is most needed. That is not speculation, that is flow. As physical silver moves, paper markets are forced to react. And paper markets do not like surprises. They are built on predictability, leverage, and confidence. When those foundations weaken, volatility is not a bug, it is a feature. This is also why official explanations often lag reality. By the time headlines admit there is a problem, the adjustment is already well underway. Silver does not wait for permission. History shows this pattern clearly. Monetary systems do not fail overnight. They fracture slowly, first in confidence, then in liquidity, finally in price. Silver responds early because it is small, essential, and physical. The mistake most people make is treating silver like a trade instead of a signal. Short-term price moves matter far less than what silver is revealing about the system behind it. This is not about predicting a number. It is about recognizing a transition. As physical demand grows and paper leverage becomes uncomfortable, the market is forced to adapt. And adaptation is rarely smooth. What we are seeing now is not the end of the story. It is the beginning of a repricing process, one driven by availability, not optimism, by necessity, not hype. Silver is exposing stress that already exists. It is not creating it. And when systems are exposed, they change. If you want to understand what comes next, you do not need excitement. You need clarity, you need patience, and you need to watch what the physical market is doing, not just what the charts say. Because when paper promises meet physical limits, reality always wins.